Best ever listeners, welcome back to another episode of the Actively Passive Investing Show. I am your host, Travis Watts, filming another episode on a walk around the neighborhood. So sometimes these ideas just come to me and it's better to record them here on the fly, even though the audio may suffer a little bit. Hopefully you can hear me and see me all right if you're tuning in on audio. Appreciate it if you're tuning in on video. Enjoy the walk. And today what we're talking about is how to dollar cost average with your investments in real estate private placements or syndications. A lot of investors are familiar with the term dollar cost average when it comes to the stock market, but you may not be aware that you can actually do this same strategy with private placements. And so that's what we're talking about here today. So I'll give you just a broad definition. If you're not familiar with dollar cost averaging, it would mean, we'll use the stock example first. You buy, let's say $1,000 worth of a stock at $10 per share. Then maybe that stock price goes up to $12 per share. You put another $1,000 in. Then we'll say that stock falls to $9 per share and you put another $1,000 in. And so you're getting basically a cumulative average price of that stock over time. So it might be like, I don't know, $10.50 per share in that example, something like that. So, Warren Buffett has a great quote. He says, if you want to focus on your investments 7-8 hours per week, then do it. But if you don't, then dollar cost average. That's a great quote. I love that. And so let's talk about, private placements and real estate syndications. We talk about that a ton on this show. They're illiquid investments, right? You put your money in and it's tied up for years on end. It's not publicly traded, right? Hence the name private placement. And so you can't just put $50K into a deal and then if you have $1,000 laying around a couple months later, you can't always put that into the deal, right? The deal might be closed and moved on. There's some structures that might allow for that, but a lot of them don't. So I'm just gonna share with you, obviously not financial advice, not telling you what to do, not saying you should do this at all, just for educational purposes. I'm going to share with you what I do to dollar cost average in these multifamily syndications that I invest in primarily. So, number one, I set up a bank account, and that bank account can be in your individual name, it can be in the name of a trust, it can be in the name of your LLC or disregarded entity. So that's a whole nother conversation. You just decide how you want to structure things. But you need a bank account exclusively for your investments, okay? The second thing is you're going to need to fund that bank account, either through capital that you have from whatever, liquidity event, you sold your house, you sold a business, you got some money in the bank, so you need to shift that over to the bank account or begin funding the account with active income. Maybe you have a job or W-2 income, 1099 income. So either way, you need to build this thing up to a minimum investment amount for a private placement. So for example purposes, I'm just going to use, we'll say, I don't know, $50,000. Okay. So you got to start with 50K, all earned active income, assuming. And then step number 3 is you need to make an investment into a private placement, but let me point something out that's very important. It needs to be a passive income investment, something that ideally distributes on a monthly basis, not quarterly, not annually, not a new development deal that doesn't have any cash flow, something that distributes on a monthly basis, ideally, okay? And I'll share with you why in just a couple minutes. So now what happens? Usually these distributions that get made to you on a monthly basis, they come in through ACH, right? Electronic transfer right back to the bank account that you have set up for these investments. So it makes it pretty streamlined, very hands-off, very systematic. So let's say that this deal that you invested in produces a 10% annualized return, just for simple math purposes. So if I put $50,000 in, I invested in some deal, 10% a year, that's $5,000 in annual distributions, right? 10%. So the beauty is, after I make that first investment with my own active income, let's say, well, I have $5,000 sitting in that bank account at the end of the year, in theory, right? So now when I do a second investment, say I do another 50K, I only have to put in 45 of my own money because I already have $5,000 in the account from the first investment. And after I do investment number 2, I have 2 passive income streams, right? Sorry, there's a there's a mower over here. Hopefully you guys can hear me all right. In fact, I'm gonna go the other way, just get away from the noise. So then I have 2 investments producing $5,000 per year. So when I go to do the third investment, right, I only have to put in 40,000 of my own money because I have 2 investments that are pumping out 5,000 per year already. So I suppose, I mean, you see where I'm going with this. It's compounding, right? And it's dollar cost averaging because each time I'm making an investment, let's say I make an investment once per year, I'm buying at a different time with different pricing in the market. You know, like multifamily housing perhaps had a slight dip during COVID, you know, March, April, May, June, July of 2020, and then had a boost in price in 2021 when inflation started to hit and after all the stimulus. And you know, interest rates have been going down for years, which affects the pricing, but now interest rates are going up, which affects the pricing. And so you're always buying at different price points with different market metrics to factor in. So you really are dollar cost averaging with your private placements over time. And so I suppose if we zoom out and we look at this macro level strategy, what are we really doing here? I guess one cool thought to me is one day you might be able to fully fund a new investment every year just by using your passive income from all of your other investments inside the account. You know, let's suppose that we get down the road and we have 10 of these investments pumping out $5,000 per year. That's $50,000 per year in passive income. At the end of the year, we could do a new $50,000 investment without having to put our own capital into it. So I think that's a pretty cool strategy myself. And again, not telling you what to do, educational purposes only, not financial advice, but I just think that's a really cool strategy. And I just wanted to share, in case you hadn't really thought about that you really can dollar cost average. So have a best ever week. Thanks so much for tuning into the show. This was a short episode. If we haven't connected on LinkedIn, let's do it, and on social media. And we will see you on another episode of the Actively Passive Investing Show.